Hey everybody, good to be here today. My name is Brent Moores and time for long options. Today I want to talk about some of the essentials of trend trading long options. There's different approaches we can take to trading long options. Trend trading is one of those approaches, a fairly common approach. I want to address that today. And so we'll get to that in just a minute, but let me just mention a couple things first. One, I'm joined by Connie Hill in the chat. Always appreciate Connie. She does a wonderful job both in the chat and in her webcast. So make sure you check some of those out, including one that you got to hit up live. That's the Trading ETFs webcast that occurs on Mondays at 4 o'clock Eastern Time. So if you're interested in ETFs, which I imagine a lot of you are, check out that webcast. You can follow myself on X. You can follow Connie on X at Brent Moore CS, at Connie Hill CS. Let me go through some disclosures here, and then we'll get to the main subject at hand. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. For the sake of simplicity, the examples in this presentation do not take into consideration commission and other transaction fees. Just make sure that you are aware of that because they can impact your trading. All investing involves risks, including the potential loss of principal. And in the case of a long options, you're risking the entirety of the trade there. We may put in a stop loss. Stop losses are not guaranteed, though, to get you out at a particular price. And so stop loss may help, but it's not a guarantee there in that regard as to what price it's going to get you out at. Rolling strategies can entail additional transaction costs. We may look at rolling one today here. And past performance of any security or strategy does not guarantee future results or success. And there we go. Let's head on over. I see some familiar names in the chat. Good to see you all here. Thank you very much for joining me. This is the Thinkorswim platform. We're using the Thinkorswim desktop software today. If your Thinkorswim looks different, it could be just a setting. There's different modes you can use. The dark mode I have, you can make the screen look more white, or maybe you're on the Thinkorswim web software page, in which case it's going to look very different. But so this is the Thinkorswim desktop software. So my goal here, talk about trend trading. I want to go through some sample rules. These are not hard and fast rules for everybody. These are not recommendations for everybody, but this is a sample plan to get you started with trend trading. Trend trading, whether you're talking about to me or sometimes in Connie's classes, she'll deal with trend trading as well, or other instructors here. Trend trading, yep, absolutely. We do it quite often. And so I think it's important to have a starting point, and that's all this is a starting point. And I always encourage people to paper trade before they actually hit up their real trading in their account. So first thing, I want to go through a sample plan as to trend trading, and then I want to go through and look at some examples. Okay, just some examples on that. Let me go. I'm going to flip on over to this, and this is just a doc I'm going to fill out with you right here together. And let me just mention with trend trading, when we're looking at a stock, and let's say the underlying stock is kind of going up, okay? So it's kind of doing this thing. But trend trade, we may look to get in and hopefully ride the trend up. And at a certain point, the trend will probably break, but we don't know when that's going to be. And so, but the point is, when you're trend trading, you're not necessarily trying to miss all the little pullbacks. Little pullbacks occur when a stock goes. The stock doesn't go up in a straight line. You guys know that. Every once in a while, they kind of go parabolic and they just go up, 10 days in a row, but that's kind of unusual. A trend trade, you're willing to sit through some of these little pullbacks here. But the question becomes, how big a pullback is too big a pullback? One way to do it is to look back at history and see, well, it pulled back about that far that time and that far that time. And therefore, if it starts to pull back significantly more, then maybe that trend is breaking. Or maybe we start to break a prior low, okay? That would be a sign that maybe that trend is breaking there. So we'll see on that. That's what we're talking about when we're talking about trend trades. Other types of trades, some people just do long-term buy and hold trades. Yeah, you can do longer term and where you're willing to hold even if the trend isn't going. That's fine, just a different style of trading. Some traders use swing trades, which will take advantage of the momentum as long as the momentum is going up. But as I pointed out on some of those trend trades, the momentum goes up and down some. And so that's the difference between swing trading and trend trading, okay? The momentum probably isn't going to stay strong for a couple months, whereas the trend may certainly last for a couple months or even longer. All right, so there we go. So that's just kind of basic what the trend trade is, and some of these rules are going to apply to different types of trades. So, for example, the watch list we're going to be looking for, probably in this class, liquid stocks with liquid options. So practically, how do we do that? Well, they're probably going to be bigger name stocks. Often I'll use the S&P 100 as kind of fishing grounds, so to speak, as to where to find options trades. Or you can go beyond that a little bit. Maybe you'll look at things with weekly options or penny increment options. But you got to be a little careful. You may assume S&P 500 stock, that's a big company. I've heard of the company, therefore it must have liquid options. That is not the case. So we're going to look at things like maybe open interest, certainly bid-ask spread as an easy indication of kind of what we're looking for. And in terms of that bid-ask spread, probably something in the range of less than 10% difference between the bid price and the ask price. Okay? So I'm hoping that is that makes sense there on that. Okay, so let me go and so we'll look at some examples and hopefully we'll point it out as we go through some of those examples. Let's go to what about potential? Again, these are like real. These are just examples by rules that some traders will use. Okay, first of all, these are trend trades. We're going to look for stocks that are trending up. Okay, or down in the case of well, we'll just say they're trending. If we're doing a long put trend trade, we want to find a stock probably that's trending down. Call option, long call option, a stock that's likely trending up. Okay, doesn't mean it's going to continue to do so, but that's where our starting point is. Now, one thing with trending stocks is you may, and we'll do this, you may use say, for example, you can use a moving average to help you with this. Okay. Now, there's a lot of different moving averages out there, and I'll pull up a chart with a 20 and a 50-day on it, but you can use different moving averages. That's fine. Just realize the shorter term the moving average, the more quickly it's going to react. And if you have a very short term moving average, the trend of the underlying stock may still be going up, even if the real short-term moving average starts to head down. So we don't want to be tricked out by that, okay? So moving averages can help. Also, when you're looking at this, we're looking for, say, trending stocks. You may also consider things like, well, in addition to the trend, you may also look at things like support and resistance. I'm just going to abbreviate S&R just to make it a little quicker to type out. And you can also consider the momentum. A lot of times traders, even if you're doing a trend trade, even though a loss of momentum may not kick you out of the trade, some traders like to see that momentum when they actually enter the trade there. Okay, so that's something we can do. And so they'll look often for a bounce or a breakout. So let me just type that in. A bounce or breakout entry would be possibilities there for you. And sometimes people will look for holds. Okay, that's a type of bounce. Or Close. That's a type of bounce, a bearish bounce, a close above the high of the low day. Okay. So there's different webcasts on this, but in fact, I did a webcast on Caholds and Cablodes just on Friday in my advanced options webcast there. So you can check that out if you want some more information on that. But basically, that's a very specific way. If you don't want to get into the details of that, if you don't want to watch that webcast, just what we're trying to look for often is like a bounce entry. That's where a lot of people do that. Okay. So let's move forward here. That's kind of, I guess, what I wanted to say in terms of our sample buy rules. But of course, once we decide, hey, this technically looks good on the stock, then what we got to decide is what do we want for the options that we're actually going to buy? Because you can do a trend trade just buying the stock, but that's not this class. This webcast we're doing right now, this webcast we're doing right now is for long options. All right. So what expiration date? What strike price? Expiration, I'm going to say it's going to be a little longer term. We're not buying an option for 3 weeks because if the trend lasts, we don't want to get out of the trade in a couple weeks. So expiration, just general guideline, I'm going to say 50 to 120 days. This is something I've kind of mentioned in the past. Sometimes are our examples outside that range? Yeah, sure. Sometimes the examples are outside that range, but that's okay. What about the strike price? What kind of strike price are we going to choose? So the way we're going to do it is we're going to look in this webcast here, we're going to look for something generally in the 60 to 70 delta range. Now, delta technically tells you how much the option is going to move in relationship to a $1 move in the stock price. That's the basic definition of delta. But we can also use this as kind of a means of identifying an option that is in the money a little bit. Okay, this is going to be in the money a little bit. Sometimes we may need to go outside that 60 to 70 range. Sometimes there's no strikes that are in that 60 to 70 range. Okay, I think that's all I wanted to say on that. We'll look at examples here in a sec. And as I mentioned earlier, bid-ask spread, I guess I could put that under the liquid options area, bid-ask spread, but this is where we're actually, the difference between these is, here we're looking for a stock that generally has liquid options, then we really want to focus on in the specific contract that we're looking at, and we want to assure that bid-ask spread is not high. So what I'm going to say is less than 10%, something closer to 5% would be preferable actually on that. And we'll look at that in just a minute when we get to examples. Risk management, okay? Risk management, I'm going to say for our purposes, about 1% risk. So that is basically your active trading or options portfolio. In this example, we're going to say that we don't want to risk more than that. So that's going to be the difference between our entry price and our stop loss. And each of you are probably thinking right now, yes, Brent, but stop losses aren't guaranteed. That is absolutely true. We can't guarantee, it's not going to guarantee to get us out at a specific price. But we're going to use that as kind of a guideline for our 1% risk. Now, can you go to 2% risk? You can. Can you go to 0.5% risk? You can. But this is just kind of giving you a ballpark figure there in terms of the risk there. Okay. And so for this webcast, I kind of usually assume like 100%, $100,000 portfolio, which means our risk would be about $1,000 max on that. Now we can go less than that if we want. But so for example, let's say I bought a 600, I'm just making up a price here, 670 option, a call option that's 670. Well, half of that is going to be, we'll say, well, we're going to put a stop loss in, and we'll talk about the stop losses here in just a sec, but I'm going to put a stop in about 60% of that price. So I'm going to say, I don't know the exact math on that, but we'll say our stop is at 430, okay? 430. What's the difference there? The difference there is about $2.50. So that's $250 per contract in that case. I could do 4 contracts using that math, okay? If we said we had a $100,000 portfolio and we were willing to risk 1% or $1,000. So that would give me 4 contracts. But just realize options are much more volatile than just the underlying stock. And so I would say in general, the odds of getting filled on your stop loss close to the option are probably less likely than the odds of getting filled to the stop loss on the underlying stock itself. But you never know. You just never know. Okay, so exit rules. So we're going to do sample exit rules. I mentioned the stop loss. We're going to probably put a stop loss on in these trades. That's what we're going to do in this webcast. And I'm going to say you can do the stop loss based on the stock price, basically put in an exit based on the stock price, where I'm going to say 1 to 2, maybe 3%, maybe I'll say 1 to 3%, 1 to 3% below low of bounce. I'll show you exactly what that is in just a minute. We'll get to that in just one sec. And so that's based on the underlying stock, okay? Or we're going to say, this is going to be similar. Let me just say this, or the breakout level. So that's an area where we can put it. Or maybe we're going to use this option price. I'm going to say about 60% roughly of option price. Okay. So there's a question in the chat, and it's a very good question in the chat. It's from John. Thank you, John. Appreciate that. John says, what about a stop limit? Okay. So just a little brief discussion of that. If you're on Thinkorswim and you just do stop, right, do the order just as a stop, that is technically a stop market order. Okay. In other words, once there's there's a price you put in that we're going to call the stop price. And once the option, or if we're talking stock goes down to that price or less, we're talking about a sell stop here, then it's going to trigger the order, and it'll turn basically to a market order and get you out. So you don't really know. It should get you out. You just don't know what price it's going to get you out at, right? Well, hopefully it's right near where your stop is, okay? Hopefully it's right there, but there's just no guarantees on that. An alternative order you can do is, as John mentioned, a stop limit order, okay? That order, once we hit that stop price, actually turns into a limit order. So you're putting in 2 prices. So let's say, using my previous example, I forgot what number I said, but let's say we put a stop in at 425 or something like that, okay? Let's say we did a stop at 425. That's the stop. You can also put a limit in, and you can say, well, yes, but I want to limit that out, and I don't want to sell for less than, I don't know, 370 or something like that, okay? So you can do that. Do you see there's pros and cons? And I'm going to leave it up to you as to which one you do. But the pro of the stop is it'll get you out. You just don't know what price it's going to get you out at. The pro of the stop limit is, you know, if it does sell you out, it's going to sell you out at, in this case, 370, which was our limit price, or better, or higher in that case. That's great, but it may never sell you out. What if the option price jumps to 350 in this example? You will never fill on that. So there's pros and cons of those. Typically in our webcasts, we teach stops, or I teach stops. I can't speak for everybody else. Stop market orders. You can use a stop limit. Just realize there's pros and cons of those, and there's more of a chance you're not going to get out at all with that stop limit just because of a gap there. But you know the pros and cons now on that. So I don't know which one you should use, but yes, you can use stop limits if you like. Okay, sample, let's see, we're doing sample exit rules. And let's see, I think I just have a few more, then we'll be done here. We said 60% of option price. We can tweak that a little bit there, okay? Maybe 70%. Generally, the way I would consider maybe the stop, if you're doing it based on the option price, is this. The further in the money the trade is, let's say you're doing something at 70 delta, 80 delta, you can probably ratchet up that option, the stop loss, tighter. Whereas if you're doing something closer to like a 50 delta, that maybe it'll be like 50% of the option price. Okay, so generally deeper in the money you go, the tighter you can make that option stop price, because there's a little less volatility in that regard. Whereas in the case of if you go in just at the money or out of the money, can't do so. You can't put it real tight. Okay. Now, we're also going to exit not just on the stop, exit on trend break. If the trend, I showed you earlier, what if the stock breaks the trend? We're going to get out, regardless of whether we're stopped out. Now, likely we're stopped out at that point, but if the trend is breaking, we turn bearish on this bullish trade, or we turn bullish on the bearish trade in the case of a long put, then we're just going to get out of that. Okay, we're going to exit or roll at 20 days till expiration, approximately. And then I think I have one more. Let's see, I jotted them down ahead just to make sure I didn't forget anything. Oh, this is a good scenario, actually. We're going to exit or roll at 80 plus, we do a plus delta. Okay, that's if the option's doing well. Because keep in mind, let's say you're doing a long put and the stock just keeps going down. What's going to happen to that put option? The delta is going to go higher and higher. So in other words, if we start with a 60 delta and we get to an 80 delta, that means the stock has cooperated with us. Things have gone well, okay? And then what we can roll, and we're going to look at an example of this in just a little bit. There's pros and cons of rolling, but I'll just give you the quick headline. It's going to generate a credit if you roll that option out, probably. So we'll take a look at that. Okay, so let's go and take some examples. Let's look at examples. I want to give you a couple examples here as we're looking at this. This is the S&P 500. I'm not going to do a trade on that right now. Of course, you can trade options on the S&P 500 index or the NASDAQ index or the Russell 2000 index. You can trade that. The webcast that occurs tomorrow at 11 o'clock Eastern Time is called Trading Index Options. And Ben is the typical instructor on that. I don't think he's going to be there tomorrow, but he's the typical instructor on that. And so you're not limited to those. But for our purposes, we're gonna stick right now, at least, with specific single stock options. I'm looking at Boeing, which just had earnings. Okay. Is Boeing typically fairly liquid? Yeah, I'd say probably. Like if you go to the trade tab, you can see, look, we're at 3 million volume today, and we're still, halfway through the day. You can look through and look at your bid-ask spread on these contracts. You can look at open interest if you like on these, and you can see this is substantial open interest. here on most of these contracts. Just be careful. Sometimes on the weekly contracts, the open interest isn't so great. Do you see that right there? So that's more of a hit and miss. Typically on the monthly contracts, you're going to have more open interest. Okay, so in terms of watch list, that's a good start there on that. But what do we want? We want a stock that is we're bullish on if we're doing a call option. And so what I'm going to be looking at is the general trend. Well, look, I said I have a 20 and 50-day moving average. Here's the 50-day moving average. It appears we're bouncing off that. We kind of didn't get quite to it before, but in general, that trend has been going up. Upward trend, higher highs, higher lows. If you need some help, you can use the moving average. You don't have to use moving averages. You can just kind of look at the stock and decide. And here we actually have some upward momentum. And another thing right now, there's still a lot of companies that haven't released earnings this kind of go around of earnings season. We're past earnings. That occurred just a few days ago. And so we have some clear sailing for a little bit. Now, if you're doing a trend trade and we're going to be in this trade for, who knows, 40 days, 50 days, you're going to encounter earnings at some point. So it's not an absolute disqualifier that there's earnings coming up, but I'm going to avoid that right now, okay? There's a survey link in the chat, everybody. We appreciate your feedback on that. But yet, let's use this as an example for a long call, okay? Long call trend trade. So remember, trend, we got the bounce here. I'd call that a bounce, okay? For those of you using the Cahold methodology, that is actually a close above the high of the low day. Potential support and resistance. This was a potential resistance. We kind of bounced off that before as resistance, came down, bounced off that. I'd call that a potential support now. So from just a technical analysis point on the stock, we're gonna call that bullish. Okay. So there we go. So that's the example we're going to use on this. Okay. Now, what option are we going to do here? Okay. So remember, expiration date. How many days? We said in our sample rules we were going to use 50 to 120 days. So I chose October. If we don't do October, we could do November. That's certainly no problem, or December. Those would all kind of fit the bill here. I'm just going to go with October here in this case, though. And I'm going to look at, okay, and then what strike? Well, we kind of said we're going to go by delta here. I'm going to go to delta, and I'm going to look at around a 60 to 70-ish delta. And you can see what we got here. There's about a 25-cent bid-ask spread. Okay, not terrible. Okay, about a 30-cent bid-ask spread. Not terrible. Now, a 30-cent bid-ask spread on a $1 option would be a problem. A 30-cent bid-ask spread on a $15, $16 option probably is not the end of the world there. That's not terrible. So I could do either of these, and they're both kind of just right in the range. So what I'm going to do is I'm just going to pick one. I'm going to pick this. And so we got our strike, we got our expiration date, and now what about a stop? Now I mentioned there's two ways to do a stop on this. And this is going to be the 215 strike. Let me just jot that down so I don't forget that. But one is we can set it based on the option price, okay, on the stock price, okay? We'll do option price as well in a sec. I'm going to go below the low of the most recent bounce. My most recent bounce is right here. We tested right basically at that moving average. The low was at 215.90. I'm just going to take my calculator out, and I'm going to go 2% below that. 215.90 times 0.98. Why times 0.98? Because that's going to give me 2% below that. Okay. 211.58. Okay. So 211.58 is going to be where I'm going to look to exit the stock there if I want to do that. Okay. Now, we could do that we could go here and we said we were going to do the 215 strike, and I'm just going to right click on it. I'm going to buy custom with a stop. And if I wanted to do it based on the stock price, I would change this from stop to market, day to GTC, and I'd click on my gear, and I'd say, go down here where it says symbol. You don't really see anything down there, but if you just click right below it, Boeing marks less than or equal to, what did we say? We said 211.58. Okay, 58. Okay, and then I would just click on save, and then I could enter the trade if I wanted to. But in this case, I'm actually not going to do that. Okay, in this case, I'm going to do it based on the option price. So I'm going to do the same thing. I'm going to go to the 215 strike. I'm going to buy custom. I'm going to go to with stop. In this case, I am going to keep it as a stop, but I want it to be good till canceled because I don't want my stop to just expire in 2.5 hours when the market closes. So good till canceled. And we said for our stop, we were going to go about 60% of the option price. Well, our initial price that we're getting in is about 19.05. So I'm going to take my calculator. I'm going to type in 19.05. I'm going to multiply that by 0.6 for 60%. That's basically 11.45. Okay. I'm going to put this in my stop at 11.45. Now, some of you who are more used to stock trades may look at this and go, that's like a really big stop there, Brent. Like on my stock trades, I would never put in that big a stop, is what you may be thinking. Options bounce around more. Options are more volatile. And so if you say, oh, I want to put my stop in at 10% less than the entry price, there's a good chance you're going to get stopped out within a day. Okay. Remember, the goal of this is a trend trade. The goal is this: if the stock is going up, it's going to have these pullbacks along the way. We don't necessarily want to get stopped out along the way, stopped out on one of those little pullbacks there. Now, at some point, if things are going well, we may move that stop up. But right now, that's where we're going to start with that stop order there on that, okay? Make it a good till canceled. I already mentioned that, I think. It's a stop. As we talked about earlier, some people you could do a stop limit there if you wanted to, but we're doing a stop market. And there we go. Oh, number of contract. How much am I risking on this? Well, I'm risking the difference here, which is about, $750. Okay. So what in this case, I'm going to do just one contract. Okay. So there we go. Now I say I'm risking that. I'm actually risking the full $1,900 of what it's going to cost there. But we're going to assume for our risk calculation that we're getting stopped out at that stop. Okay. All right. Let me confirm. And so let me just address a question here that came in. So this is from Chris. This is an interesting question. Is there a logical way to use a delta as a basis for a stop? Probably, but it may. Okay, so I don't want to spend too much time because I don't want to get too far off. Think about it this way. If the stock drops, if we're starting with the 60 delta, okay, and of course, if the stock, that's where our option is right now. If the stock drops, right now what's going to happen to our delta there of the delta of the stock of the current price is going to go down. But if we had a lower strike, once we get to certain, I'm talking in circles here, Chris, I'd have to think about that one a little bit. I can't think off the top of my head as to how it would be practical to use a delta right now on that. Maybe, but I'm gonna let me ponder that one a little bit because I don't want to spend 5 minutes thinking about it in front of you right now. and put everybody to sleep here on this. So the answer is maybe, but I'm not, I haven't done it that way. And we're going to stick with the two ways that we just did right now. Good question though. Interesting question. So here's what I'm going to do. I'm going to confirm and send this. And I'm going to send this as, we're going to put this in long single options. I'm going to send that trade, and it's thinking that it did fail. Okay, so we got Boeing in there. Let's do one more example, and then what I want to do is I want to go to look at management of one that we've had in the past. Okay, so here's an example of one. I'm going to do Coke, and I'm going to call this more bearish. Okay, I'm going to call this more bearish. So why am I calling this more bearish? Because I have high, lower, high. We kind of have this channel almost going down here. Okay, so in general, we've been kind of doing this thing. Okay, so in general, going down, we've been using our 20-day moving average, looking maybe for a bounce there off that. One thing you could do is you could say, I only want to get in if this actually gives me the bounce. Let's say I only want to get in if the stock goes below the low of this day. That would be like our kablode. Well, the price of that low is 68.75. That's the very bottom of this candle that I'm on right now. Okay? 68.75. Okay, that is our entry price if the stock goes below there. Now, what I'm going to do is I'm going to do similar things, except I'm doing a put here. I'm going long a put. So I'm going to go to trade. If the stock goes down, some of these put contracts, and I'm going to stick with the 50 to 120 days. I'll stick with the 73 days. I'm going to look at my puts here on this. And let's look at our delta. If the stock goes down, no, notice we don't have a 60 to 70 delta right now. But if the stock goes down, this 53 delta is going to get closer to the 60 delta. So this actually will probably be fairly close to 60 delta by the time this thing fills, if this indeed does fill. Our bid-ask spread is nice and tight on that, by the way. So I'm going to right-click on this. I'm going to buy custom with stop. And again, we could do the trade based on the option price if I want, or I could do it based on the stock price. I'm going to get in based on the stock price and out on based on the stock price in this case. Okay, and beauty at its best in a question. I'll get to that question in just a minute here. Okay, so in this case, to get in based on the stock price, I said I only want to get in if the stock goes below 68.75. Entry, market, good till canceled. Click on my gear. I'm going to say I only want to get in if Coke marks less than or equal to 68.75. Okay, so we got that. Okay, what about our exit there? What about our exit price? Well, we said we can do it based on the stock or the option. Well, let's look on based on the stock. Look, I want to get out if this thing turns bullish on me. So what I'm going to do is I'm going to say I'm expecting it to bounce down from here. And remember, we're only getting in if it does bounce down from here. If it just keeps going up, this entry order isn't even filling because we're only getting in if the stock goes down below this level. Okay? So, but if it does go against us, and let's say it bounces down and we fill, and then it breaks above here, about 60, what did we get, 69.50, then I want to get out. And I'll give it a little wiggle room, okay? So I'm going to go 69.50 times 1.02. I'll go 2% above that. That's 70.90, okay? So I'm going to get out if we go to 70.90. If it gets there, we're going to get out of this trade, okay? The trend is gone at that point. So let's do it. Let me put this trade in. And now I did 2%. You can certainly do 1% and make it a little tighter. I'm going to change this from stop to market. I'm going to make it good till canceled. Okay, we're going to do this again because it didn't like me going out of that. Buy custom with stop. Okay. Market. Good till canceled. Market. Good till canceled. We're only getting in if Coke marks less than or equal to 68.75. We're going to get out if Coke marks greater than or equal to 70.90. It was actually 70.89, but I'll do 70.90. Okay, there's the trade. I'm going to confirm and send. You can read over this, and then you can send it. Now, remember, this is not going to fill right away because this is a contingent order. This is based only if Coke actually bounces down at this point. The assumption is the trend is going down, but we're going to wait for that bounce to get in. Okay, now, you'll notice I didn't put target prices on these. Why? Because these are trend trades. As long as this continues to trend down, we're going to continue to stick with the trade. Okay, let me give you an example of one. We did a trend trade on Adobe before. We bought a put, and it's doing quite nicely right now. But let's look at it real quick. So here's Adobe. Trend has been going down. Now, we can certainly move the stop. We also may consider rolling. Here's Adobe. Okay, this was the long put. We still have 45 days to go, so there's no urgency to get out. We traded this for $24, and right now it's about $48, okay? But notice our delta is about 77, so it's not quite at the 80 threshold. Remember when we went through those sample rules that we talked about before? We said if we get to the 80 level, okay, when we get to that 80 level, then, and we're close, we're not right there. Why would we roll there? Well, there's reasons to roll and there's reasons not to roll. But let's just look at this. Let's go to Adobe and talk about if we were to roll this, what would happen, okay? The current trade is right here. It's around 49 bucks. Well, we'll say 48 and a half dollars. If we were to roll this down from 385 down to, say, we'll go to 65 delta, about 33. We'd be rolling 49 minus 33. That's roughly a $1,500 credit we'd be bringing in. I'm just rounding, but that would bring in about $1,500 in cash there on that roll. That would be very nice. That's the pro of it. That's great. That's kind of reducing the overall risk in the sense on the trade. Taking some of the skin out of the game, so to speak. Now, the rolled option could still go down to zero at that point after we roll it. There's no doubt about that. And remember, there's going to be commissions. That's one of the downsides. There will be a commission and fees when you do the roll. Okay, it doesn't save you it. You still got to pay those. But effectively, what it'd be doing is it would be rolling us from that 78 delta down to about a 64 delta. Is that good or bad? Well, yes and yes. It's good in the sense that if the stock then reverses itself, then we're actually going to be losing money at a slower rate than we would otherwise. In other words, we're taking a little bit of the risk off the table. But if Adobe continues to go down strongly, we've lowered our delta, so we'd be making money at a lower rate in that point. Now, in this case, because our delta doesn't quite meet our rules, I'm going to hold off on that. But that is why you would potentially roll Remember, when we were talking about those rules, that's what we did today. We talked about these rules. One of those rules is we'd roll at that 80 delta. You can bring in a credit if you do that. What do you roll it to? You roll it back to the initial conditions of the trade there, 60 to 70 delta, using this plan at least. Okay, so what did we talk about? We talked about trend trading calls today and trend trading long puts as well. There is a survey link in the chat. Everybody, we do appreciate your feedback. Would you just take a minute? It's only going to take you literally just 1 minute to fill out this survey if you click on that in the chat. Connie, thank you for helping me out in the chat today. I appreciate you, as always. Coming up next, we've got getting started with technical analysis. Okay, that's coming up. So make sure you check that out. And everybody, thank you for your time, and we'll see you all same time next week. Bye-bye, everybody.